Everyone keeps telling you that the economy is recovering and that the stock market is at all-time highs. But if everything is going so well, why does the average American feel poorer than ever before? And why does your paycheck seem to disappear faster than it did just 3 years ago? The answer lies in what economists are quietly calling the silent crash, a phenomenon where the nominal value of your assets might look fine on paper, but your actual purchasing power is being eroded at a rate we haven't seen in decades. And in this video, we are going to break down exactly how this is happening through three specific mechanisms: debt, housing, and inflation. And more importantly, we are going to discuss the exact steps you need to take right now to protect your wealth. To understand the severity of this situation, we first have to look at the debt trap because right now, American credit card debt has smashed through the $1 trillion mark, a historic record that signals a deep underlying problem in the economy. Because people aren't borrowing this money to buy luxury cars or go on expensive vacations. They are using credit just to afford basic necessities like groceries and gas. And with interest rates on credit cards now averaging over 20%, this creates a vicious cycle where you are effectively paying double for everything you buy over time, meaning the cost of living isn't just rising, it is compounding against you. If you are sitting there waiting for the Federal Reserve to save the day by cutting interest rates back to zero, I have some very bad news for you because the era of free money is officially over, and we are entering a new cycle where the cost of borrowing will stay higher for longer. Which brings us to the second major crisis facing the middle class, which is the broken housing market. The American dream of homeownership is rapidly becoming a nightmare for the average family because if you look at the math, a mortgage rate of 7 or 8% compared to the 3% rates we saw a few years ago means that the monthly payment for the exact same house has nearly doubled, effectively locking out an entire generation of first-time buyers and freezing the market because nobody who currently has a low rate wants to sell, creating a shortage of inventory that keeps prices artificially high, even though demand is crashing. This situation has created a renter society where institutional investors and massive corporations are quietly buying up single-family homes to turn them into rentals, knowing that if people cannot afford to buy, they have no choice but to rent. And as rents continue to rise, your ability to save for a down payment diminishes every single month, trapping you in a cycle of paying off someone else's mortgage instead of building your own equity. But perhaps the most dangerous enemy of all is the one you cannot see, which is the inflation tax. Because even though the news headlines might celebrate that inflation has come down to 3%, that is a misleading statistic that tricks most people into thinking prices are going back down, when in reality, it just means prices are rising slightly slower than before. But the massive 20 to 30% price hikes we saw in food, insurance, and energy over the last 2 years are permanent, and they are never going away. This is effectively a silent tax on your savings because if you are keeping your hard-earned money in a traditional checking account, earning 0.01% interest, you are mathematically losing money every single day that you don't invest it, which is exactly why the gap between the rich and the poor is widening so aggressively right now. The wealthy hold assets like stocks and real estate that inflate in price when the dollar loses value, while the middle class holds cash and debt which gets destroyed by inflation. So the burning question is, how do you actually pivot and protect yourself in this environment without taking on reckless risks? The first and most immediate step is to stop being loyal to big banks that pay you nothing and move your emergency fund into a high-yield savings account, which is currently paying between 4 and 5%, which is literally risk-free money that you are leaving on the table if you don't switch, effectively allowing you to offset some of the damage caused by inflation without doing any extra work. The second step is to shift your mindset from being a consumer to being an owner, which means you need to own a piece of the economy through diversified investments like the S&P 500. Because history has shown us time and time again that while the stock market crashes in the short term, over the long term, it is the only consistent hedge against the devaluation of the currency, meaning that when corporations charge more for their products, their stock prices eventually go up, protecting the purchasing power of the shareholders.